when your stock is going to report earnings, it's one of the times that anxiety is at the highest for traders. And the reason why is because you get these huge swings where it could go great in your favor, or it could crap the bed and it gaps down against you and it wipes out your profits, or you could end up losing more than you anticipated on that trade. And so a lot of traders, a lot of professional traders that I've seen too, have gone and said that, well, don't trade earnings, right? Like just sit and wait, and that's a strategy, right? But I would prefer to come up with, well, what's a better way to trade earnings? How can we still participate? Because there's plenty of opportunity, right? And so when we start to dissect, well, what's the problem with holding through earnings? It's the volatility, and it's the gap risk, where a price could gap way up or it could gap way down. And the concern is that you could end up losing dramatically more than you would anticipated. Okay, fine. Now that we know what the risk is, how can we come up with strategies to minimize those risks? Well, I've got two for you. The first one is figuring out, can I use options on this trade? So the beauty of using calls or puts is that you could treat the premium that you pay as your risk, right? So let's say you see that Apple is reporting earnings in a week, and you want to trade earnings on Apple. Great. So you find some call options. Let's say they're trading at $2, right? So you find that these calls are trading at $2. So if you're not familiar with options, multiply by 100. Each contract is worth 100 shares, or lets you control 100 shares. So you multiply by 100, and so a $2 option is going to cost you $200. Okay, fine. So that means that if we're treating that entire premium as your risk, then you buy one, you're risking $200. Amazing. So the worst that could happen in this scenario is that it goes to zero, right? And the most you're going to risk is that 200. Now your risk is capped at 200, versus if you bought shares and price gaps against you, you might have lost significantly more than you thought. All right, fine. So that's how we're capping risk with using options. In that one example, not every trade is going to be an options trade. There's certain things that you'll need to figure out if this is worthy of being an options trade or not. Things like liquidity and the things like, is there mathematical edge in this? Like a wide variety of things. We'll go deeper into that in another video, but for the sake of this, understand that options give you one way to limit risk. Okay, fine. So what's the second way? Second way is by changing your position size based off of where support is. So let's say so presuming you already understand support and resistance. If not, other videos that you could go watch on this channel about that. But let's say that you're entering at 100, your first stop loss is down at 95. So you're looking at that, it's just like, I'm gonna risk 5% on this. Okay, fine, that's reasonable. But what happens if it gaps down? Where's the next level of support? So figure out where the next level of support is. If the next level of support, like let's say this thing has had this gigantic run and there's a support level at 95, but beyond that support is way down at 80. Are you willing to risk 20% drop in your face to get to what maybe you perceived as a run to, I don't know, 115, right? Have like what would normally be a 3-to-1 reward to risk. You risked $5 to get 15. Well, in this scenario, your risk is actually you're risking 20 to make 15. In that case, maybe you take a pass on this trade because the reward to risk is not in your favor anymore. But let's say that you have tighter reward to risk. Let's say that it made sense to get in at 100. Your stop loss is still at 95. The next major level of support is down at 90, but you think that this thing could go to 150, right? Maybe it makes sense to still take the trade. Maybe you drop your stop loss down, or you play it where you would still exit the trade at 95, but your position sizing based off of 90. Or you could just say, you know what, instead of risking 1% on this trade, maybe I'll risk 0.5% of this trade. Maybe I'll risk a third of a percent or 1/4% on this trade, but I still believe in this, where I want to, if it does break out, I want to at least have a toehold in this idea. So I'm going to put on a little bit. That's a way to limit your risk. Manage your position size. Lots of ways to get into an earnings play based off of position size, based off of options, and you don't need to just sit on your hands and watch trades go by. If there's a will, there's a way, and you can figure it out.